In this video, I'm going to talk a little bit about some of the types of annuity contracts and how they function a little bit and some features associated with them. So in general, one of the things that's worth noting for annuity contracts is that they typically have tax-deferred growth. And so the money is accumulating value during that accumulation phase, that the taxes are deferred on that until later. And I'll address that more when I get to a video on taxation. But for now, basically, there is tax-deferred growth, which is a beneficial thing. Now, there are a couple sort of broad flavors of annuity contracts, and the three big kind of flavors that we have as it relates to this would be the fixed annuity, the variable annuity, and the equity indexed annuity. So fixed, variable, and equity indexed annuity. So for the fixed annuity, basically, this is one in which the sort of the rate at which you're gaining value and the payouts that you're ultimately going to receive are basically going to wind up being fixed. But there is a little bit more to the story. So there's typically an initial rate of sort of return that's being earned on your basically it's an investment, right? So there's an initial rate earned on the investment, but then that's going to be followed by some kind of renewal rate that's going to reset at some point, which means it's going to depend on what's going on with market factors and things like that. Oftentimes with fixed annuity contracts, they will specify a minimum investment rate or interest rate. So this sort of provides a little bit of a floor of even if market interest rates drop below that, there's at least a minimum interest rate here that you would receive. And there can be surrender charges if you have excess withdrawals during the accumulation phase. So if you're withdrawing excessively during that period of time when it's supposed to be accumulating, then you can face surrender charges for that. The next type that I'm going to talk about is the variable annuity. So a variable annuity is basically going to be linked to the return of the investment options that are selected. And really, the variability is happening during the accumulation period. So what's basically going to happen is going to be accumulating, but how much it accumulates depends upon what happens with the investments that are selected. And then eventually, the person will hit a point in which that annuity is annuitized, and then the payments occur. And so then it's going to be essentially more locked in at that point. But you don't really know what those payments are going to look like starting out. You really don't have much of an idea because it depends an awful lot on what happens with the returns on the investment options. So from that standpoint, this is going to be a more complicated type of contract because we now have managing the annuity contract itself and sort of the fees associated with collecting the premiums and all of that. But also you have investment options. And so the annuity providing company is going to have some of these different investment options, and they're going to have fees. So think mutual fund fees, things like that. So investment fees, mutual fund fees, probably record keeping fees, all kinds of fees, basically. So typically they're going to be a lot more fees for this. And it raises the question at some level of, well, so, to the extent that it's variable and linked to investment options, at what point would it have been more prudent to just invest it in investment options in perhaps low-cost index funds, and then when you get closer to retirement, take it out and just annuitize it into like a fixed annuity with a single lump sum payment. And so that's a valid question, and that would be something you'd want to evaluate carefully to determine whether that actually made more sense. Now, with the variable annuities, there are various riders that can be added to those policies. Among them would be a guaranteed minimum accumulation benefit, which basically says, all right, guarantees that you're going to wind up accumulating a certain amount. Now, obviously, that's going to come at higher cost. Another approach would be a guaranteed minimum income benefit rider. So this would be, all right, you're going to pay extra costs on your premiums, but it's going to guarantee that you're going to have a certain, at least minimum income level that you're going to receive. Another approach would be a guaranteed minimum withdrawal benefit that would guarantee that you could withdraw at least this amount after you've made all these payments, the premium payments and things. So again, that's going to come with extra cost as well. And another one would be a guaranteed lifetime income benefit that would guarantee a certain amount of lifetime income. So all of those riders really kind of, if you think about them, really what they're kind of doing is is sort of eroding away at the edges just how variable a variable annuity really is. So, that's kind of what they're doing, where, people like the idea and sometimes of the variable annuity where they are investing in or making different investment choices, and so maybe they get more growth, but they kind of don't like the downside, and so that's where some of these guaranteed minimum accumulation, income, withdrawal, whatever, some of those riders sort of start to put limits on just just how variable that outcome could actually be, but that comes at extra cost too. Another type of annuity would be an equity indexed annuity. So an equity indexed annuity is an annuity that has a minimum guaranteed rate. It's kind of a minimum guaranteed rate, but then it's going to have a link to an equity index rate of some sort. Now, there are some different ways for how that is actually linked or indexed to an equity index. So basically, that means that it's important to pay attention for an equity index annuity to how exactly this is indexed. And so the indexing method would matter. And this is really kind of looking at how the rate of change in the index is measured, because that will impact kind of what happens to the annuity and so forth. So one way that the index return or rate of change can be measured is do an annual reset. So every year they basically look at what the index has done in relative to the prior year, and they kind of evaluate that annually. Another way would be a high watermark. And so for a high watermark, they look at sort of during the period, what was the highest index value. And so that's your high watermark. And then they judge relative to that basically when determining sort of the equity returns that they're then going to use to sort of possibly boost you over the minimum guaranteed rate. And then you get to the point-to-point index linked crediting method, where they're looking at some point to some other point, and then they're basically evaluating index returns over those points. And again, then they're going to use that to determine, how much you do or do not get above that minimum guaranteed rate. Now, what's kind of significant to note is that the term that they're using when kind of assessing equity returns could be all over the place, and it could be up to 10 years. So they could be looking at over a 10-year return period for the market or equity index to determine what rate of return is being generated. So it could be quite a lengthy period of time there. It might be shorter as well, but it could be quite a lengthy period of time that they're using to kind of assess that. Now, once you have kind of that equity link and how much above the minimum rate and all that, one of the things that's important is what's called the participation rate. So the participation rate is, okay, so if the equity index got 10% relative, the gain relative to however they're measuring these the gains, whatever method. So if it was 10%, if the participation rate is 70%, then they're going to take 70% of the 10%, and now you're going to be looking at basically like a 7% gain, basically. And one of the things that they can also have in some cases is a floor crediting rate. So that would be kind of how low it could be for whatever sort of your minimum rate is. So kind of the floor of how bad it could get, because if you're linking this to equity indexes, equities can go down. So you could conceivably lose money. And so if there is a floor crediting rate, basically what that would mean is it basically limits on just how bad it could be. So in some cases, that floor crediting rate could be 0. So if the market actually went down, the good side is the account would not decline like the markets did. But it's also kind of worth noting that it's a minimum of 0. And so they aren't really guaranteeing much of a return there. It's really going to be linked to whatever happens to equity returns, but also factoring in all the fees and the participation rate, et cetera, which again starts to kind of point back to at what point does it make sense to contemplate maybe having a properly diversified portfolio of very low cost index funds and cutting out all the fees and things like that, or maybe even a life cycle fund or something like that. So at what point does it start to make more sense to do something along that line as opposed to kind of doing these equity indexed annuities, which are linked to variable returns anyway, but now you've got a bunch more fees. So that's something to kind of evaluate, and that's where a personal financial planner can kind of work through whether or not it actually makes sense to go those routes or not. For somebody who has discipline to stick out an investment plan, an investment strategy, and not mess with their portfolio inappropriately and so forth, it might make more sense to possibly do a portfolio of index mutual funds and things. If it's somebody who is going to sell when there's a downturn in the economy and make bad choices for their investments, maybe the annuity option makes more sense, even though there are going to be a lot of fees and things involved. But anyway, those are some things to kind of think about and consider. Hopefully this video has been helpful. Thank you for watching and have a great day.